All opinions expressed by Andrew Whalen, employees at Whalen Financial, or any other podcast guest are solely their own opinions and do not reflect the opinion of Whalen Financial. Whalen Financial is a registered investment advisor. This podcast is for information purposes only and should not be relied upon for investment decisions. Clients of Whalen Financial may maintain positions in the securities discussed in this podcast.
We got a lot to talk about. Obviously, Russia's only continued to invade Ukraine despite sanctions. Doesn't seem like they're stopping. We did just have the State of the Union. We could get into that, but we don't want to bore people too much. We want to keep this short and concise. So let's just jump right into the conflict that's going on in Russia. There's a tremendous amount of commodities that are exported from Russia every single year. And I was looking up an article that was written in Reuters, and I just kind of want to run these numbers by you because it's kind of shocking on a large number of, everyone just kind of thinks of, oh, it's just oil. And, that's one component of global GDP. But aluminum, they export about 6% of total world production. Cobalt, that's used for batteries, they export more than 4% of the total world production. Copper, about another 4.5% of the world production. Nickel, about 7%. Here's a big one, palladium and platinum. They export almost 40% of global mine production. And of gold, they export about 10% of global mine production. Steel, another 4% of global production. Diamonds, here's a big one, unless you're, just in case you're getting married this year, 30% of global total production of diamonds comes from Russia. Fertilizer, this is probably why Mosaic's been on a run recently. They export 13% of the global total fertilizers. And wheat, it's not just Ukraine, it's also Russia. They export somewhere close to 17% of global total production. So those are commodities, not including oil, that Russia is responsible for exporting. Let's talk through the implications of just a slowdown in Russia, right? Not even talking about sanctions, but if this drags on for 2 or 3 or 4 or a year, like Bill Miller thought it was going to, the implications on, anywhere between 5 to 17 to 30 or 40% of some commodities are going to be drastically impacted.
Right. It's clear that if there's a protracted conflict here, that it's going to be more disruptive to the global economy than most of the wars and conflicts that you have around the world. If there's somewhere where there isn't a lot of production of a lot of different things, or consumption either.
Well, I mean, it seems like a diversified pie of commodities that's coming out of just Russia alone, not even counting Ukraine. And then the surrounding areas, if they have to be more defensive, or if other countries have to maybe get involved, what that looks like on the global production scale.
Right. So, as GDP estimates and global GDP estimates will have to get revised in coming months to account for all of that, and it also will fuel inflation here, and we're kind of seeing that already with the oil price spike that's happening. It's really it started when all of this, when this conflict went live a week ago, and it's continued over the last week. So that's everything that's happened in the last week has made us kind of reevaluate our views and think about things along the lines of inflation. Probably isn't going to settle down as quickly as we thought it would. And then, even though the expected path of Fed rate hikes is slowing down, there still is a lot of inflation and probably going to be more. It's all leading us to think that we should probably get a little more defensive sooner rather than later. But we're still reevaluating all of that right now. We don't want to make any decisions too quickly, and we'd like to look for some good bounces too.
Right. Yeah. And what's going on in Russia and Ukraine isn't just limited to those commodities that we talked about. a lot of those commodities are direct inputs into a lot of individual products that go within the global supply chain. So when we heard from Apple and Tesla earlier this year on their earnings calls, they didn't really quite figure in the component pieces that may be required to complete certain things when they gave us estimations that the supply chain should be fixed by 2023. They didn't really account for that. And case in point, so the Wall Street Journal came out with an article this morning. It was titled, "Ukraine War Plunges Automakers into a New Supply Chain Crisis," basically talking about, and I'll just read it verbatim, after a pandemic and a global chip crunch, Russia's war in Ukraine has unleashed automakers' third supply chain crisis in many years. And that kind of gets back to the point of some of those precious metals and some of those components are used to create semiconductor chips that then feed into cars, or just parts themselves, if we're talking about steel. So this conflict could cause a lot more problems than obviously ease the pain of inflation, definitely in the near term. So we wanted to address that. That was really interesting as far as the supply chain and kind of what's going on is the components of commodities that come out of Russia. One other thing was, so we talked about this earlier today of, okay, let's say we wake up tomorrow and Vladimir Putin is deciding that, hey, I made a mistake. Just kidding. We're done. That doesn't mean that this is all just going to go away right away, right? I mean, they're not, the foreign countries are going to be like, hey, don't worry about it. We're going to remove all these sanctions, better luck next time. And that could be something that is also impacting the prolonged nature of the recovery, specifically in supply chain, commodity prices, everything else, right?
Right. I mean, when you get significant military actions by countries and dictators, if they start doing damage to other countries, like that's not something that they can get away from really easily. Usually people just continue fighting.
Right.
There isn't really an easy way to back down because, now like the victors are going to impose law on you. And, there's probably no way he can return to, just going back to, the leader of Russia and, not having any repercussions. Like there's probably no way for him to go back to the world like a few weeks ago.
Sure. And that puts him in a very unique...
even if he said that, well, we're going to stop. We're sorry.
Right.
I mean, it doesn't really work that way.
Yeah. And, obviously a lot of people are being affected by this. And even companies here domestically are taking action. And I did notice, and we talked about it earlier today, even Josh Brown at Ritz-Hold is starting to pen letters to some of these ETF providers of saying, hey, you should liquidate. It's not morally right. And obviously there's a free market system, but we'll see how that all pans out. And when we're not mentioning, I don't want to go into tremendous amount of detail into, is what role does China play in all of this? And could that escalate things even further if they decide to import the oil that people are refusing to import?
Right. I mean, that's something that people are thinking about too. It's probably a low probability event that China decides to, help Russia and buy what they can't sell to the Western world, but it's not a 0%.
It's not a 0%
chance thing. It would be unwise of them, and they probably won't do it. But it's something that could happen. But all of this that's happened in the last week or two, really the last week with all the sanctions on Russia, and the pain from it, it highlights how globalized and interconnected the world is now.
Sure.
Things were a lot more isolated in the past, but now, if a country wants war, like there are a lot of consequences.
Well, yeah, 40% of the wheat produced in Russia. Like, what do you think your Kellogg cereal is going to cost in the next month?
Well,
or a couple months.
Right. Now, like all the stuff in the United States is coming from here because like we're a wheat exporter too, but it just raises the price on a global level. So yeah. So when you go to, pick up your Wheaties, General Mills is going to be raising the price on that.
Sure. So another thing that we've seen a huge drastic price change just in the last week or so is the price of oil. So what I wanted to talk about was how does that really affect, in your opinion, what are the consequences of US GDP? Let's walk through what that really means. And, if it stays at a relatively sustained level for a prolonged period of time. Can you explain that?
Right. Well, historically, oil price spikes have led to recessions, and they've typically been just a consequence of the economy growing, and there isn't much additional supply, or you're right up against the supply limit, and so oil goes up, and typically that happens late or at the very end of a business cycle.
Right.
So we've had a lot of late business cycle signs, but we haven't had any of the Fed rate hike activity. But yet we're having this oil price spike because of a military conflict.
Sure.
So,
let's share
but-
that. Let's share that chart as you keep talking about that.
But yeah, I mean,
So what's this chart talking about, Carl?
so this chart right here is the historical oil price and how it's changed on a percentage basis versus its long-term trend over the last 50 years.
Yeah, I think
And
Bianco Research put this out. Yeah.
you can see that it's tended to go up at the end of business cycles, and a lot of people say it's one of the ingredients that helps cause recessions, because oil is kind of a special commodity because it affects the price of everything, just to move things around. And also natural gas is used to make fertilizer, so fertilizer often goes up at the same time, and when that goes up, then agricultural commodities go up too. Like everything goes up at the same time. But the biggest spike on here is actually the Gulf War in 1990, as you can see there,
Right.
in the middle. And that was, that was, at the beginning of a recession as well.
Sure. Yeah.
So-
Essentially, what this chart shows, just to break it down really simple, is anytime we've seen a 50% price movement or more in the price of oil, that typically preceded a recession. And that doesn't mean that it's absolutely true and going to happen and history is going to repeat itself, but it is just another indicator of something that we watch of a shortened business cycle when we're looking at investing portfolios. So this is something really interesting. Obviously, the higher the price of oil, like Carl said, the higher amount it costs to transport goods, and the more money that you're spending on a monthly basis of your budget, which energy is, an abnormally large amount next to shelter of someone's monthly budget. The more that's going there, the less that you're going to go out to eat, or the less new clothes you're going to buy, or the less experiences you're going to go on. And that all slowly contracts the economy, which brings me to my second to last point, which GDP revisions for the fourth quarter are now 0 to negative, right?
Right.
And they're
they're
blaming
the Atlanta Fed does some good.
And that's
work on
real
this.
GDP. It's not nominal. It is real GDP. So it back ends
Right.
inflation. But what that essentially means is how much are we spending versus how much prices have gone up and what the net difference is. And what they're predicting is somewhere close to 0. So, obviously the economy is slowing. It was hit by Omicron. Clearly, we're not going to see the 7.5 or 7% GDP clips that we saw coming out of the pandemic. But it is another cause for concern on the Fed, which is our last point. The Fed came out this week and basically announced that everything's on pace to raise rates 25 basis points in 2 weeks at their next meeting in March. And I'm not sure if it's enough. Like I said last week, I'd be okay. They need to come out and give some kind of stability, but at the same time, like what you and I said, you've got not only the conflict, but now you have oil prices coming up. You've got all these commodity pressures that are going to keep inflation higher. And that kind of puts them in a big pickle.
Right. I mean, we expect inflation to be higher now and not lower. So it's interesting that the Fed wants to have a smaller rate hike as opposed to a larger one.
Right.
Kind of makes it seem like, they're not really doing their job, or maybe they don't.
Well, they're not.
Maybe they don't care. Maybe supporting financial markets is more important than preserving the integrity of the currency.
or following their dual mandate. So it'll be interesting. I think we covered a lot of stuff on this weekly sense. This, the second to last one, next Friday, we move to the new office. So we'll do one for next week. It'll be the last one. I'm looking forward to it. Carl, anything you like to close with?
Well, we're just watching everything carefully and trying to think about what the best moves from here are. It's a difficult environment, but we're confident that we'll make good decisions pretty soon.
Thanks, Carl. Appreciate it. Have a good weekend.
You too. Have a great one.
All opinions expressed by Andrew Whalen, employees at Whalen Financial, or any other podcast guest are solely their own opinions and do not reflect the opinion of Whalen Financial. Whalen Financial is a registered investment advisor. This podcast is for information purposes only and should not be relied upon for investment decisions. Clients of Whalen Financial may maintain positions in the securities discussed in this podcast.